Well, greetings, my beloved clients and friends. I want to talk to you today about what's going on in the office. We've been doing a lot of research lately, and the emphasis has been on analyzing market bottoms, and because we're asking the questions, are we there yet? What will it look like when we get there, and what should our response be? If we're not, how should we be preparing? Those are the questions that we're asking. We want to navigate through this. I know the second quarter was pretty rough, and seems like we've had a bounce from the middle of June, but we're not ready to necessarily declare victory yet. And so my initial thoughts, maybe even hopes, was that we were this time around we might see a rolling bottom, like, okay, innovation bottoms first, and then tech, and then S&P, then Dow, or something along those lines. And because some things were starting to look really cheap, and I'm like, I don't see an overall general bottoming of the market, but there are some pockets that looks like it's already bottomed, So maybe certain things will bottom first and stuff like that. But I mean, to be honest, from the research that we're looking at, the tendency is for everything to bottom at the same time. So it was a little discouraging, and I said, well, shoot, I got to tell my clients the truth. And so I gotta manage according to what is, not what I wish it would be. And so we looked at several different market pullbacks, and the two that we're really focusing on, because they seem to have the most similarities to the one that we're in now, is 2000, which was actually 2000 to 2002, top to bottom, and 81, which was actually November 80 to 82, top to bottom. So, and what makes the 2000 one very similar, have similar characteristics to this one? Well, one, it was a kind of an overheated market. I mean, the 90s were great for the stock market, and it started getting overvalued. And even in 98, Alan Greenspan came out and said, you know what, there's just irrational exuberance in the markets right now. And it was another almost 2 years of more irrational exuberance that took the market even higher before it topped out, and then we had that extended pullback. So, and it was in the run-up, it was disproportionately tech, and towards the end, it was really innovative stuff like .com, which I mean, they were right. That is the future, the internet and stuff. But it was a little bit early. They were betting on companies that were still pre-revenue, pre-positive cash flow and stuff like that. So I'm going through a steep part right here. But and so that was kind of similar to where to how the market's been recently. And there was a trigger, which was Y2K. They said Y2K, the computers are going to mess up because they don't have 4-digit dates for the year. So everyone needs to buy computers. So this massive spend from government, corporations, schools, military, individuals. Everyone needed to buy a new computer. So those companies, it was kind of like COVID, right? Oh, we got to get the economy back on track. So let's massive spend. This was spend from the government. Last time it was spent from government, military, corporate, education, everything. It wasn't handouts. It was actually buying stuff, but it made those companies look great and made their stocks take off. And then it abruptly ended. January 1st, the computers worked, and so that need to continue buying new computers was not there because everyone already had new computers. So on a sidebar, I'm kind of curious that was it really true? Were there people in 2000, like in 2020, it's like, wow, I don't believe this COVID thing? Were there people that said, oh, I don't believe this Y2K thing, and they didn't buy a computer? And did their computer not work on January 1st? I'm not sure. Governments and businesses and military and schools and stuff didn't take that chance, but I'm sure somebody said, I don't believe this Y2K thing. And did they have to go buy a computer on January 1st? I don't know. So that's just a side note, it was just a thought. But so it was very similar in that sense, that we were coming out of an overpriced market, and really the market needed to correct. And there was this kind of one-time shock of Y2K, kind of like the COVID spend, and there was a new innovative technology that was catching a lot of interest, but that really wasn't backed by anything, which at that time was the dot-com thing, and this time around you could call it crypto. So there were many similarities. So we were really analyzing that. The difference was, one of the big differences was that at the time interest rates were about 6%. So if you were looking at the market, you say, man, it's awful rich, or I think I better pull back, or even after it started pulling back, like, I think I better diversify. You had an option, and that option was 6% bonds. Like, I could stay in a 6, or you could even get conservative 7% high quality corporate bonds. So you get 6% government bonds. So you had an alternative, right? Which the bond market this time around didn't really offer an alternative. They were starting at 0% bonds, and rates were going to go up, which are not good for bonds. So I thought that was going to change the dynamic a little bit, because there wasn't an easy out for the money to go to. And the other thing, the other second alternative you had in 2000 that you didn't have this time around was real estate. Real estate had gotten crushed in 91, 92 with the Keating 5 and the SNL scandal, and it really was kind of a quagmire for the 90s. About 97, you started seeing it bottoming out and picking up, and that would have been a great time to buy, but there wasn't a rush into it because the stock market was so hot. So real estate was it was pretty low and had room to go if you were in 2000 and you said, well, let me is there another avenue for my money besides the stock market, which has been hot? And so you could say yes bonds, yes real estate. Where this time around, there's not an attractive bond market as an alternative, and real estate has had as big a run as the stock market. So I thought that would make it not such an easy out for money in stocks to go someplace else. But there were a lot of similarities besides those differences. And the second market pullback that we're looking at very closely was the 81 to 82. And what happened there? That was when Reagan got elected. Inflation was out of control. We're just coming out of the Jimmy Carter era, and inflation had been going on throughout the 70s. And then Volcker, the Fed chair at the time, he come down hard and he says, we are gonna stop inflation. We have to. And we're gonna take the country into a recession, but we have to, because we have to stop inflation. And he took rates up to like 18%. And it worked, by the way. He put an end to the inflation. He ushered in a 40-year era of very little inflation, and the Reagan era was a great time to be in the stock market after that initial pain of 80 to 82. So Chair Powell, he's taking a similarly strong stance against inflation, and he's raising rates aggressively, and he's making that his focus regardless if it pushes the economy into a recession. So a lot of similarities. So those are the two that we're looking at as guidance, and we haven't come with any solid conclusions yet, but I just wanted to give you an update on what we're doing, what we're thinking, and how we're analyzing and steps we're doing to manage during this difficult time, and to protect and grow your wealth. I was going to say something about 80 to 82. Oh, so here's an interesting an interesting tidbit. There was a 20-year. It was 20 years from 82 to 2000 to 2002, and then guess what? Another 20 years, and we're in a situation similar to those last two. So we're noticing some patterns, and so we're trying to study those and understand them better, and to make good decisions for you. And so when we make decisions, we don't want emotions to come into the room. We leave them outside. But I do bring my gut in, because I've been in this business 30 years, and if I haven't by now developed a gut that's going to help me go in the right direction, then something's wrong. So, but data, facts, research, patterns, that's what we're looking at, that's what we're analyzing, that's what we're studying, and we listen to our gut as well. And so hopefully we're not going to be perfect, but hopefully we'll generally make right decisions that will help us navigate through this and get you to the other side in good shape. All right, so we'll keep you updated on what we're seeing and what decisions we're making. So I hope these videos are helpful, give you a sense of security that we're doing what we can to manage through these times. All right, have a great day.